Ed, you say on natural gas, this perfect storm shall pass. This market should loosen up later on. Ed, just walk us through the current thinking at Citi compared to the consensus view that I'm sure is giving you some pushback at the moment.
Well, on natural gas, we're getting a significant amount of pushback. The issue that we see is where markets are loosening up. And remember, we're dealing with a problem that's in the power generating sector, not at the moment in the transportation sector, not in buildings, not in industrial processes or agricultural processes, but very specific to fuels in the power gen sector. We're seeing China actually going all out for coal. They are already looking at producing 13.5% more coal this year than last year. They're adding 100 million tons of domestic production this year, and in the following 2 years, each another 100 million tons. That's going to displace imports into China, making coal available for the rest of the world. And at the same time, they're reducing their imports of natural gas. Year to date, they're way down. They have other supplies of natural gas other than LNG imports. They have pipeline gas from Uzbekistan, a big jump in pipeline gas from Russia. Their domestic production of gas went up around 6 or 7% last year. It's going to go up 8 to 10% this year. And they just simply need less natural gas. That's going to loosen up markets and provide a significant amount for Europe. So what we see happening is a progressive reduction in where European and global gas prices are, and along with that, gas prices in the U.S.
How much do you factor in, Ed, some sort of ban or overall embargo on Russian gas imports to Germany?
We actually think that's a very low likelihood on both sides. And if Germany is not going to use its veto power in the EU, Hungary certainly will. So we don't think there's going to be an overall European community agreement on not pulling in natural gas or oil from Russia. We don't think the Russians are going to pull back because income is better than no income. We actually think that, and that's another kind of controversial point, that where Russia is now, the volumes that Russia is now exporting of natural gas could go down, but they also could go up. There's tolerance in the contracts with European countries to add on above the take or pay contracts that they have. And if they added on what they could by contract, assuming that the ruble payment issue is dealt with, which we think it would be, actually more gas means lower prices. And if we get the volume right, it's lower revenue for Russia. So it's another strategy that may be not politically satisfactory, but it could actually work.
Ed, for so long, many months now, we've been focused on the supply equation, on how tight supply is. Now the conversation's shifting back, it seems, more so toward demand, especially when you see a Chinese economy that is looking incredibly weak in the face of persistent COVID-0 policy. How are you thinking about China and the demand story, not just for fuels, but also the metals as well?
Well, it's not just China in demand. There are other countries as well. But for China, it looks as though demand is down more than 1 million barrels a day year to date. It doesn't look like that's going to come back anytime soon. We think they're going to keep the blockage on international travel through the end of the year. So there's much less room for growth from China than people had thought. Certainly not the 700,000 barrels a day of growth that the OPEC Secretariat has been thinking that's going to come from China. We think it's going to be negative growth for the year, maybe not 1 million barrels a day under year on year, but a negative number. And it's also the U.S. where we've not seen demand increasing at the degree to which we would. Indeed, for the last 4 weeks on a 4-week moving average, U.S. gasoline demand is lower than any year in the last 5, except for that deep cut in demand during the 2020 deepest part of the pandemic. So U.S. demand has actually stalled out. Just as Chinese demand has been reduced, European demand is going to be lower, emerging market demand is going to be lower. It would not be surprising to see significant projections going down for where demand is going for the rest of the year.
Just finish on supply in the US. It's been creeping up recently. Ed, where do you see that topping out? It's about 11.9 million barrels a day at the moment.
Yeah, and that's 900 a day year on year, by the way. We think it's going to keep growing at this rate through the end of the year. So if we add all liquids, including natural gas liquids, we've just raised our outlook for U.S. production to be 1.4 million barrels a day year on year, deck. We think it'll be getting very close to that 13 million barrel a day peak that we saw in the winter of 2019-2020. And the momentum that's built from that should be adding another million barrels a day in 2023. So we think that one of the reasons for tight markets has been that drop in U.S. production, but U.S. production is coming back very strongly, and would be even without the encouragement of the U.S. government.